Okay, let's unpack this. Welcome back to the deep dive. Today, we are getting into something that is just so vital for any business owner.
It's one of those topics that can feel a bit, well, terrifyingly complex.
Exactly. We're talking about successful business succession, specifically for private Canadian corporations. And this isn't just about a simple will.
No, not at all. We're really drilling down into the integrated legal and tax blueprint you need when you have multiple owners, real assets, and you actually want to preserve that legacy.
And this kind of planning, especially when you have co-owners, is just so high stakes.
It really is. Our sources all point to the same recurring truth. You know, the failure to properly document and, critically, to fund a succession plan. It doesn't just cause a bit of friction.
It actively destroys things.
It can obliterate family legacies. It can completely destabilize a profitable, healthy business almost overnight.
And we have to start there, right, with the reality of that failure. We have a story that just perfectly illustrates the catastrophe this planning is meant to prevent.
Yeah, this one is. It's a tough one. It was a company called Land Planning E Corp, a service firm co-owned by partners for more than a decade. And one of the main partners, the father in the family, passed away completely unexpectedly.
And what happened next was immediate.
Instantaneous conflict.
Yeah.
I mean, while the family is still grieving, still trying to figure out the probate process, they get this aggressively low offer from the surviving partners.
So why? Why the hostility? Why the lowball offer right out of the gate?
Because there was absolutely nothing documented. Zero. No binding valuation formula, no agreed upon price, and definitely no funded plan. It was a complete vacuum.
And the surviving partners just jumped right into that vacuum. They based their offer only on the tangible assets.
Exactly. Equipment, cash in the bank, hard property. They submitted this, frankly, insulting offer that completely ignored the real value generators of the business.
They ignored 14 years of work.
14 years of accumulated goodwill, brand reputation, all their unique processes, and, the most critical part for a service firm.
The client relationships.
The key customer relationships that the deceased partner had spent his entire career building. For a business like that, goodwill often exceeds the value of the physical assets, sometimes by a factor of 2 or 3.
So to ignore it, it's not a real valuation.
It's a fatally flawed valuation. And the consequence for the family was that all their liquidity just vanished. They were forced into this incredibly expensive litigation just to argue about what the business was actually worth.
A process that should have been automatic.
It dragged on for 6 months. It cost them upwards of $25,000 in legal fees just to negotiate for what should have been theirs from day one.
And in the end,
the relationships were shattered. The family got, pennies on the dollar for what the business was truly worth.
And that delay, those fees, that just erodes any remaining value.
It erodes everything. And the stress, the uncertainty, it almost crippled the surviving business operations as well. It's a perfect illustration. If you don't have a plan, the default outcome is chaos, expense, and just diminished value for everyone.
So our mission today is to move you past that fear of complexity and actually give you the technical tools to create a guaranteed, predictable outcome. We're breaking down the 3 integrated pillars you need to avoid this nightmare.
Right. There's the rock-solid legal structure, the strategic Canadian tax advantage, and the absolutely necessary instant funding mechanism.
And we have to stress this point. Getting these 3 things to work together seamlessly, to be legally binding and tax efficient, it demands highly specialized knowledge.
Absolutely. This isn't something you can just ask a generalist advisor about. The way corporate law, the Income Tax Act, and insurance funding all interact is so intricate. A mistake in one area can completely invalidate the benefits of another.
So you need specialists who are focused specifically on these integrated solutions for Canadian business owners.
You do. That's the only way to ensure that the legacy you spent decades building is actually transferred smoothly and tax efficiently.
Okay, so let's start with that first essential pillar, the legal bedrock. What is the buy-sell agreement, the BSA, and why is it so foundational?
The BSA, or sometimes you'll find these detailed provisions inside a larger shareholders agreement. It's truly the legal prenuptial for the business.
A prenup for the business. I like that.
It is, because it addresses the core problem of owning a private corporation. It's illiquid. You can't just go online and sell your shares on the TSX tomorrow to get cash. There's no ready, impartial market.
So the BSA's job is to create that market, a private mandatory market.
Exactly. Its main job is to create guaranteed liquidity for an asset that has none. It legally forces 2 things to happen. First, When a specific trigger event occurs, the shares must be sold.
No arguments.
And second, the surviving partners or the business itself must buy them at a price that comes from a pre-agreed formula. You decide the rules now while everyone is friendly and rational and alive, not in the middle of a crisis.
Death is the obvious trigger, of course. But a really comprehensive BSA anticipates situations that are way, way messier than death. So what are the crucial triggers a good agreement has to cover?
We usually group them into 4 buckets. The first is what you call the unexpected catastrophes.
So death or a permanent disability.
Right. These events demand immediate funded liquidity. The agreement has to have clear, undeniable timelines for starting the purchase, based on, medical or legal proof. No ambiguity.
Okay, bucket number 2. The planned transitions. These should be easier, but they still need structure.
Things like retirement or a voluntary exit. The BSA sets the terms for a smooth, often staged transition. This stops an owner from just quitting on a Tuesday and demanding a huge cash payout that would gut the business financially.
So it might say something like you get installment payments over 5 years, or you have to give 6 months notice.
Exactly. It manages the cash flow and operational stability.
Then you get into the really difficult stuff, conflict and distress. How does a BSA act like a referee when partners just can't work together anymore?
It has to define an exit mechanism that doesn't involve going to court. And this is where you often see the notorious shotgun clause.
Ah, the shotgun. It sounds intense. Walk us through how that works.
Yeah.
How does it stop an endless deadlock?
It's brutally efficient. It forces one partner's hand. So if there are irreconcilable disagreements, partner A can issue a notice to partner B. That notice has a single price, let's say price X, and it gives partner B only 2 choices.
And those choices are?
Partner B must either buy all of partner A's shares at that price X or sell all of their own shares to partner A at that same price X.
Wow. That really forces partner A to propose a fair price, doesn't it?
It does. Because if you propose a ridiculously low price, you run the risk that partner B will just say, great, I'll buy you out for that steal of a price.
It incentivizes fairness because the person who triggers it could end up on the receiving end of their own offer.
Precisely. It resolves a crippling conflict almost instantly. Without it, the business could be stuck in expensive judicial dissolution for years.
Okay, and the 4th category is the most offensive one. The BSA as a shield against external threats. Why is this so critical?
This is all about protecting the integrity of the ownership group from the personal disasters of one single shareholder.
So, like bankruptcy.
Take bankruptcy or insolvency, yeah. A good BSA has to state that if a shareholder declares bankruptcy, their shares are immediately and compulsorily offered to the other partners or the corporation for purchase.
And the goal there is to stop a creditor from seizing the shares and selling them to some unwelcome third party.
You don't want a hedge fund or a competitor suddenly becoming your new co-owner. It keeps the ownership group closed and trustworthy.
And the same logic applies to something like a marital breakdown or divorce.
Exactly the same. The BSA has to stipulate that shares can't be transferred to an ex-spouse as part of a property division. The agreement gives the corporation or the partners the first right to buy those shares to protect the business's internal stability, its proprietary information, and its operational focus.
So the BSA defines the when and the why a sale has to happen. Now we have to get into the who. Who pays for the buyout? And this decision has huge tax implications down the road.
This is maybe the most strategic decision in the entire blueprint.
We're talking about the choice between a cross-purchase structure and a redemption structure.
Right. Because this choice defines the future capital gains tax exposure for whoever is left. It dictates who pays for the funding, but more importantly, it determines what happens to their adjusted cost base, their ACB, of the shares they continue to hold.
Let's start with the first one, the cross-purchase, where the surviving shareholders buy the interest personally.
In a cross-purchase, it's just like it sounds. The remaining shareholders personally buy the shares from the departing shareholder's estate. If you're using insurance to fund it, each shareholder personally owns a policy on the life of their co-owners.
So the insurance money flows to the surviving owner, tax-free, and they use that cash to complete the purchase.
Correct. And the huge, massive long-term benefit of doing it this way is the basis step up.
The ACB step up. Can you explain what that means in real dollar terms for the people who are left?
Yeah, the ACB step up is the golden ticket here. Your adjusted cost base is basically your historical cost of your shares for tax purposes. When you, as a surviving partner, personally purchase more shares, you get an immediate permanent increase in your own personal ACB equals to the full purchase price you just paid.
Okay, so if I own shares with an ACB of, say, $100,000, and I buy an additional $1 million stake from my deceased partner's estate.
Your total ACB instantly jumps to $1.1 million.
And the so what of that is?
The so what is critical. Years from now, when you eventually sell the entire business for, let's say, $5 million, your taxable capital gain is that sale price minus your total ACB. That higher ACB drastically reduces your future tax bill. It's a powerful, delayed tax-saving strategy.
That seems like an absolute no-brainer benefit. So why would anyone ever choose the other option, the redemption model, where the corporation buys back the shares?
The redemption or the corporate buyback is almost always chosen for one reason: premium efficiency today.
It's cheaper now.
It's cheaper now. The corporation owns the insurance policy and pays the premiums with corporate dollars, which are taxed at a much lower small business rate. So it's easier on the current cash flow.
But the downside is huge, right? It's that classic trade-off.
Yeah.
Immediate cash flow ease versus major tax pain down the road.
That is the crux of it. When the corporation redeems the shares, the remaining shareholders get a bigger piece of the pie, economically speaking. Their proportional ownership goes up. But their personal outside tax basis, their ACB, remains completely unchanged. It doesn't move a dime. Because the company bought the shares, not them personally.
So even though their stake in the company might have doubled in value, their personal tax cost to those shares is still the original low number. Their future capital gains exposure is way, way higher than with a cross-purchase.
That's it, exactly. People choose redemption when paying premiums personally out of their own high tax pocket is just too expensive today. Or maybe they see the business as a long-term income generator, not something they plan to sell in the near future.
So they're prioritizing current tax efficiency.
Over future capital gains mitigation, yes. But if you think there's any chance of a big sale in the next 10 or 15 years, that ACB step up from the cross-purchase is probably worth the short-term pain of higher personal premium payments. You're basically investing in a smaller future tax bill.
That's a perfect summary. It's a strategic choice, not a one-size-fits-all thing.
You really have to model both scenarios.
Yeah, okay, moving on. That structural choice doesn't matter much if the price is wrong. And that brings us right back to our opening story, the failure of the valuation. How do you make sure the valuation method in the BSA is fair, accurate, and crucially defensible against the CRA?
A detailed pre-agreed valuation method is your only real defense against months or even years of paralyzing litigation. If the method is spelled out explicitly, there's just no room for the partners to fight about it later.
And that valuation has to be holistic. It can't just be the hard numbers.
No, it has to be. The quantitative stuff: revenues, adjusted earnings, cash flows, debt, that's the foundation. But the qualitative metrics are what capture the true market value, especially for service firms.
Things like market position, client lists.
Unique internal processes, and the big one, goodwill.
Right, goodwill. That thing that was completely ignored in the land planning E-Corp case. The value of expected future earnings beyond what the physical assets can generate.
Correct. For so many modern businesses, the value of goodwill is paramount. If your BSA allows the valuation to ignore that, the agreement is just fundamentally flawed from the start.
So let's get into the main options you can put in the BSA. The gold standard seems to be fair market value, or FMV.
FMV is the highest price you could get between knowledgeable, informed, arm's-length parties. If your BSA just says an independent FMV appraisal will be obtained at the time of the trigger, that gives you the most objective and accurate price based on current market conditions.
But it's not known in advance.
Right. It relies on an expert doing a complex valuation when the event happens.
So the second option, agreed value, seems so much simpler, but you said it holds the biggest risk.
It's so tempting because it gives you certainty. The owners sit down today and agree the company is worth, say, $3 million. They sign a certificate of value and promise to update it every year or two.
But the danger is complacency. The set it and forget it trap.
It's a huge trap. Imagine they set the value at $1 million 5 years ago. But the business has boomed, and today is really worth $2.5 million. If a partner dies and the buyout uses that outdated $1 million figure,
The family just lost $1.5 million.
just because nobody updated a piece of paper.
So how does a well-drafted BSA protect against that very human tendency to forget?
It builds in a safety fuse. It will say something like, if the agreed value has not been resigned and dated within the last 18 months, this valuation method is void, and we default to an independent FMV appraisal.
It forces accountability.
It does.
Okay, third is the formula-driven price. This seems like a good middle ground.
It can be very effective as long as the formula is chosen carefully and it's relevant to your industry, you use a mathematical equation like 3 times the average adjusted EBITDA over the last 3 years. The price automatically tracks the financial health of the business.
So you don't need a meeting every year to agree on a number.
Right. But, just like the agreed value, the formula itself needs to be reviewed every few years. Industry metrics and multipliers change.
And the final fallback for when there's a dispute, the independent appraisal process.
This is your mandatory resolution process. The BSA will say, for example, the buyer hires an appraiser, the seller's estate hires one, and if their valuations are more than, say, 10% apart, they have to jointly hire a third binding appraiser.
So it guarantees you'll get to a final defensible price without ending up in court.
That's the goal.
Now, we can't talk about valuation without talking about the tax man. The CRA is always watching, especially in non-arm's length deals like passing shares to a child. What is the CRA valuation tax trap?
It's a devastating and surprisingly common crisis for family businesses. Let's say a parent transfers shares to their child for a price of $1 million. But later, the CRA audits the transaction and successfully argues that the true fair market value at the time was actually $1.5 million.
So what's the tax hit for the parent who sold the shares?
Under the Income Tax Act, the parent is taxed on the $1.5 million proceeds, even though they only got $1 million in cash. They suddenly have a massive tax bill on $500,000 of phantom money they never actually received.
That would trigger an immediate cash flow crisis.
A severe one. And the nightmare doesn't stop there.
What happens to the child?
To make it worse, the child's adjusted cost base might only be the $1 million they actually paid. This can lead to double taxation on that phantom $500,000 when the child eventually sells the business years later. It can financially ruin a family succession plan.
So if the CRA can just come in and retroactively change the price, how do you protect yourself from that uncertainty?
The only real protection is something called a price adjustment clause, or a PAC. This is mandatory language that has to be built right into the share purchase agreement itself.
And what does it do?
It legally binds both parties to automatically and retroactively adjust the transaction price to whatever FMV the CRA ultimately decides on.
So if the CRA says it was $1.5 million, the contract automatically changes the price to $1.5 million.
Correct. This does 2 things. First, it solves the phantom proceeds problem for the seller. But second, and this is crucial for the CRA, having that clause in there signals that the parties acted in good faith. They were trying to transact at fair market value. Without that evidence of good faith, the CRA might not even recognize the adjustment.
That is essential clarity. Okay, we have the legal mechanism, the BSA, and we have the price. Now we need the cash. The opening story showed the partners had no pre-funding. They had to scramble for a loan. Let's really quantify the staggering cost of relying on debt, the debt trap.
Relying on debt when a key partner dies is the ultimate continuity killer. You're taking on a massive, immediate financial burden that will hobble your future profitability for a decade or more.
Let's do the math. A $1 million buyout financed over 10 years at 7% interest. The total cash repayment is about $1.42 million. How does the business actually fund that, given our tax laws?
We have to look at the pre-tax income required, because that's the true cost. Let's start with Scenario A, personal borrowing for a cross-purchase. The shareholder takes out the loan personally.
And let's assume they're at a top marginal tax rate of 50%.
So to service that debt, they have to pull taxable income out of the company. For every $1 of loan repayment, the company has to generate and pay out $2 of pre-tax income.
So to service that $1.42 million debt,
the corporation has to generate and pay out an estimated $2.85 million in pre-tax income over those 10 years.
Wow, that's nearly 3 times the original loan amount. That is an unbelievable financial drag on a business.
It's crippling. And that's almost $3 million that could have been used for expansion or hiring or innovation. It's just gone forever. Now, what about Scenario B, corporate borrowing for redemption? The corporation takes the loan.
And we'll assume a small business corporate tax rate, maybe 12%.
The efficiency is better, but the cost is still massive. To service that same $1.42 million debt, the corporation needs to generate about $1.89 million in pre-tax profits.
So it's cheaper, but it's still a huge diversion of resources.
The conclusion is undeniable. Debt financing isn't a solution. It's just an expensive, disruptive deferral of the crisis. And that's if you can even get the loan.
Right. There's always the risk the bank says no after a key partner has just died and the business looks shaky.
And then the family is forced to accept an unsecured IOU from the remaining partners. They go from being secured shareholders to unsecured creditors, betting on the future success of a company in crisis. It's an unacceptable risk.
And this is where life insurance becomes so critical. It's the only thing that converts that massive, uncertain liability into instant, guaranteed, tax-efficient cash.
It requires only a small, manageable annual premium. It completely solves the funding crisis.
For listeners thinking about this, what type of policy is best for this kind of buy-sell plan?
It really depends on the expected lifespan of the business. If you think the business will likely be sold or wound down in, say, 10 to 20 years, then term insurance is the most cost-effective. It's pure coverage for a specific period.
But if it's a generational business, something meant to last,
Then you need permanent coverage, whole life or universal life. This guarantees the death benefit will be there no matter when someone passes away. It locks in their insurability for life, and importantly, it allows for tax-deferred cash accumulation inside the policy itself.
and that cash value can be used for other things later on.
Exactly. It can be used to help fund a planned succession event, like a retirement buyout. It adds a lot of flexibility.
So now we get to the real Canadian tax innovation that makes all of this work so well. Corporate-owned life insurance, or CLI, and the magic of the capital dividend account, the CDA.
This is the centerpiece of sophisticated Canadian planning. With CLI, the private corporation is the owner, the premium payer, and the beneficiary of the insurance policy. The corporation pays the premiums with its lower-taxed corporate dollars.
And when the partner dies, the death benefit flows into the corporation completely tax-free.
That's right.
So then the question is, how do you get that tax-free cash out of the corporation and to the estate without triggering a massive dividend tax? And that's where the CDA comes in.
The CDA is a notional account. It's a paper account inside the corporation that tracks specific tax-free amounts. And the net proceeds from life insurance are a primary example. The whole purpose is to let those funds flow out to shareholders as a capital dividend, which is completely tax-free to the person who receives it.
It avoids double taxation. Okay, so how do you calculate the exact amount that gets credited to this CDA? The formula is the death benefit minus the adjusted cost base of the policy. Why do you have to subtract the ACB?
This is a really important point. You should think of the policy's ACB as the corporation's cumulative net economic cost of that policy over its life. The CRA sees that amount as just a return of the capital the corporation already spent.
So if the corporation paid, say, $150,000 in net premiums over the years, that's just getting its own money back. It's not a new gain.
Exactly. Only the net economic gain, the death benefit that exceeds that cumulative cost, is considered a new tax-free addition to the corporate surplus. And that's the amount that gets credited to the CDA.
So in a simple example, a $1 million death benefit minus a $150,000 ACB.
Results in an $850,000 credit to the capital dividend account. And that $850,000 can be paid out completely tax-free to the estate.
Provided the corporation does the paperwork.
Provided they filed a T2054 election form with the CRA on time. If they miss that election, the entire payout becomes a taxable dividend, and the whole efficiency of the plan is just obliterated.
Let's just quickly circle back to the premium efficiency point. The savings from using corporate dollars are really significant.
It's huge. If a premium is $5,000 and the corporation is in a 12% tax bracket, it only needs about $5,700 in pre-tax income to pay it. If an owner paid that same premium personally from their 50% tax bracket,
the corporation would have to pay them $10,000 in salary for them to have that $5,000 left over.
right, you're saving over $4,000 year after year. That's real capital you can reinvest in the business. And it also solves a fairness issue.
With that,
In a cross-purchase plan, a younger, healthier partner might resent paying really high premiums to insure an older, higher-risk partner. When the company pays for it all, it feels more equitable. The business is bearing the cost equally.
now for the most critical legal failure point with CLI, you call it the jerk move scenario. Why does the BSA have to legally force the distribution of the CDA?
This is a devastating flaw that can happen even in a well-funded plan. When the corporation gets that $850,000 CDA credit, the remaining shareholders, acting as the board of directors, have the legal discretion to decide who gets that tax-free capital dividend.
They don't have to give it to the deceased partner's family.
They absolutely do not, unless the BSA contractually obligates them to. They could legally decide to pay the entire tax-free CDA portion to themselves, the surviving shareholders.
And leave the family with what?
They leave the family with only the remaining fully taxable portion of the redemption proceeds. So the family gets hit with a huge unexpected tax bill, while the surviving partners get a massive tax-free windfall.
That's why the integration between the legal document and the tax planning is non-negotiable.
It has to be. The BSA must contain specific, binding language that mandates the corporation file the T-2054 and pay the maximum available tax-free CDA exclusively to the estate of the deceased shareholder. Without that clause, the tax-free benefit is legally unprotected.
Okay, we have the tax-free funds flowing, but now we need to zoom out and tackle the bigger Canadian two-level tax problem that hits shareholders at death. This is where it gets highly specialized.
It does. Level 1 is the deemed disposition. The moment a shareholder dies, the CRA deems them to have sold all their capital property, including their private company shares, immediately before death at fair market value,
which triggers a capital gain on their final personal T1 tax return. This is where the $1.25 million Lifetime Capital Gains Exemption can come into play if they're qualified shares.
Correct. The LCGE is your first line of defense against that Level 1 tax. But even if you use all of it, Level 2 is still waiting.
And Level 2 is the deemed dividend. When the corporation redeems the shares from the estate, the cash the estate gets is treated as a fully taxable dividend. So you've got a capital gain tax and then a dividend tax.
And the goal of advanced planning is to eliminate Level 1 and use the tax-free CDA to shelter Level 2. The primary technical strategy to eliminate Level 1 is the loss carryback, sometimes called the pipeline strategy.
This is a bit counterintuitive, so let's walk through the steps slowly. Step 1, death happens.
Right. The shares are deemed disposed of at fair market value, let's say $2 million, triggering a capital gain. That $2 million then becomes the estate's new high-adjusted cost base. The estate inherits the shares with that stepped-up cost base.
Okay, step 2. The corporation redeems the shares for $2 million in cash. What are the estate's proceeds of disposition for capital gains purposes? This is the tricky part.
The cash comes in, but for the capital gain calculation, the proceeds are reduced to basically nil. This is because the Income Tax Act says the cash received is a dividend, not proceeds of a sale. And it can't be both.
So the estate gets $2 million in cash, which is a dividend, but has zero proceeds for capital gains. Step 3, the loss calculation.
The estate then calculates a huge capital loss. Its ACB of $2 million minus its proceeds of zero gives it a $2 million capital loss.
And step 4 is the carryback.
The estate takes that massive capital loss and carries it back to the deceased's final T1 tax return, which offsets and effectively cancels out the Level 1 capital gain that was triggered at death,
leaving only the Level 2 deemed dividend, which is then sheltered by the tax-free CDA from the insurance.
That's the perfect execution of the strategy.
And the 2024 budget proposal made this a little easier to do, didn't it?
It did. It provided much-needed flexibility. It used to be that the estate had to realize that loss in its very first tax year. Now they have the first 3 years of a graduated rate estate to realize the loss and carry it back, which helps a lot with probate delays.
Beyond the pipeline, there's the other deferral strategy, the spousal rollover. How does that interact with the BSA?
The spousal rollover is great because it defers that Level 1 tax until the second spouse dies. But there's a critical constraint. The shares have to vest indefeasibly in the surviving spouse.
Meaning they have to get true outright ownership with no pre-existing legal obligation to sell.
Exactly. If your BSA says shares go to the spouse, but they must be redeemed within 90 days, the CRA denies the rollover and the tax is triggered immediately.
So how do you fix that?
You use a put-call option structure. The shares are first willed to the spouse, so they vest indefeasibly. Then the BSA separately grants the remaining partners the option to buy the shares, the call-in, and grants the spouse the option to sell the put. Because they're options, not obligations, the rollover succeeds.
That's brilliant. And then the surviving spouse can use their own Lifetime Capital Gains Exemption when the option is eventually exercised,
maximizing the tax shelter for the family. But we have to mention the final hurdle here, the stop-loss rules. This is where non-specialist advice can really break down.
Well, what are the stop-loss rules?
They're the CRA's way of preventing what they saw as double-dipping when corporate-owned life insurance is used in a pipeline strategy. They basically said you can't get the benefit of both eliminating the Level 1 capital gain and getting the full tax-free CDA dividend for level 2.
So the CRA actively reduces the capital loss the estate is trying to create. What's the practical impact?
The capital loss that the estate can carry back is reduced by a formula that's tied directly to the CDA credit generated by the insurance. This means the estate might not be able to eliminate 100% of the level 1 capital gain.
So the level 1 tax is mitigated, but not necessarily zeroed out.
Exactly. Navigating these rules is what separates the real experts. You have to be able to model the formula to know exactly what the remaining tax liability will be and plan for it.
We've spent a lot of time on death, which is at least clear-cut, but long-term disability is often way more disruptive because of its ambiguity. Why is disability the ultimate minefield?
Because disability is messy. It can be gradual. It can be temporary. If you force a buyout the moment someone can't work, what if they recover 6 months later? The company just bought them out for no reason, and they're left without their business.
So the BSA has to build in a waiting period.
It's non-negotiable. The BSA must specify a survival period, usually 18 to 24 months, before the buyout obligation is triggered. The owner has to be continuously disabled for that whole time. It allows a buffer for recovery.
And the second critical error is the disconnect between the legal definition and the insurance policy's definition.
This is absolutely essential. If your BSA says disability is the inability to perform core duties of this business, but your disability buy-sell insurance policy defines it as inability to perform any occupation,
the business is on the hook to buy the shares, but the insurance company won't pay the claim.
and you're left with a massive unfunded liability. The definitions have to be 100% identical.
Let's quickly run through the funding options for disability.
For the buyout itself, you use disability buy-sell insurance. It provides a tax-free lump sum to the non-disabled owners to buy the shares. Because the benefit is tax-free, the premiums are not tax-deductible.
And what about covering the bills during that long waiting period?
For that, you use disability overhead insurance. It pays a monthly benefit to the business to cover ongoing costs, like rent and salaries. Because it covers operating expenses, the premiums are deductible, and the benefits are taxable income. It's designed to be a tax wash.
And critical illness insurance is a key piece here as well.
CI is a complement. It provides an immediate, personal, tax-free cash payout to the owner upon diagnosis of a covered condition, like a heart attack or cancer. It gives them personal liquidity right away, regardless of whether they eventually trigger the long-term buyout.
Finally, continuity. Beyond the legal and financial side, losing a key owner creates an immediate vacuum. What do the surviving partners need to do right away?
They have to project stability. That means proactive communication. Calling your major customers, reassuring your suppliers about credit lines, and meeting with your bank immediately to confirm loan covenants are secure and that you have liquidity from the insurance.
That liquidity isn't just for the buyout, is it?
No, it's the operational fuel for survival. It's the cash you need to recruit and train a replacement, to maintain stability, and to ensure that the crisis of an ownership transfer doesn't become a crisis of business failure.
So what does this all mean?
What we've unpacked today really proves that succession planning for a Canadian private corporation is a high-stakes, multi-layered process. It's not something for a generalist. It demands seamless integration of legal structures, dynamic valuations, and very specialized Canadian tax mechanisms.
And if you fail to integrate those pillars, if you have an outdated valuation, the wrong buyout structure, you're relying on debt, or you miss that one critical clause in the BSA, any one of those flaws can completely obliterate the wealth you've built.
Understanding the true cost of debt, the massive efficiency of CLI, and demanding that perfect alignment between your legal and tax plans gives you, the business owner, a huge quantifiable advantage in securing your legacy.
So here's a final thought for you to carry forward. The true measure of your success as a business owner isn't just today's profit margin. It's the guaranteed, instant, tax-efficient liquidity you have secured for your family if something unexpected happens.
Yeah, you have to ask yourself that tough question. If my business were suddenly valued today, would that number, and more importantly, the instant tax-efficient cash secured to back it, ensure the business I built doesn't become a massive, agonizing burden on the very people I sought to protect? That level of preparedness, that's the ultimate test of stewardship.
For listeners who recognize that this level of detailed, integrated planning is absolutely necessary, we strongly encourage you to reach out to specialists who live and breathe this stuff. Munis Financial Services has been a leading firm in Vancouver since 1995, specializing in this exact work for Canadian business owners.
Their whole focus is on creating customized solutions for life insurance, annuities, RRSPs, and health and welfare trusts, making sure the legal, financial, and tax components are all perfectly aligned. It's exactly what's needed to prevent the kinds of failures we talked about.
You can reach them directly. Their cell phone and text number is 778-898-3202.
And you can also reach them by email at mansour@munirist.com.
For more information on their comprehensive services, you can also check out their website at munirist.com.
It really is about focusing on running your successful business and leaving this highly specialized financial and succession planning to the specialists.
Thank you for joining us for this deep dive.